Bell Canada this week reported their fourth quarter financial results. And well, if you want to know how they were, perhaps this will say all you need to know. That's right, the equity tumbled over 6% on Thursday after reporting the results, which was followed by a further fall of 6% on Friday. All told, the equity crashed 11.9% following the release of earnings. And quite frankly, we don't know if the equity has found solid ground just yet. And it gets worse from there. We just might be seeing the death throes of one of Canada's telecom giants, at least as the company that we recently knew them as. The last time Bell closed this low was nearly a decade ago on January 21st, 2016. Things aren't looking good, folks. Let's dive in. Okay, guys, let's start off with the high level, the earnings. Bell published their fourth quarter results on February 6th, and well, the top line of the Associated News release consisted of the words, "All non-revenue and revised revenue guidance targets for 2024 achieved." In other words, sales are slowing. The fourth quarter saw revenues decline by close to a full percentage point, dropping from $6.47 billion to $6.42 billion on a year-over-year basis, with the decline blamed on lower service revenue due to a hyper-competitive communications market. Which is funny considering they are one of like 3 telecoms in the country. Would hate to see how they would do in a real free market. Despite the revenue decline, net earnings improved by 16% in Q4, climbing from $435 million to $505, equating to EPS of 51 cents, while adjusted net earnings hit $719 million or 79 cents a share, a 4% improvement over the prior year. Adjusted EBITDA improved much less dramatically, climbing 1.5% to $2.6 billion in Q4 of 2024. Things were less rosy in terms of cash flow, with cash flow from operating activities declining 21% on a year-over-year basis, dropping from $2.37 billion to $1.88, while free cash flow fell 32% from $1.29 billion to $874 million. And while the fourth quarter performance may have been okay from a year-over-year perspective, once you exclude the declining revenues on a full year basis, Bell seems to be struggling. Revenue in 2024 declined 1.1% from $24.7 billion to $24.4 billion. Net earnings fell 84%, crashing from $2.3 billion to $375 million, which is a result of massive write-offs earlier this year in the Bell Media segment. Adjusted net earnings fell 5% from $2.93 to $2.77 billion. Cash flow from operating activities fell 12% from $7.95 billion to $6.99 billion. And free cash flow fell 8%, dropping from $3.14 billion to $2.89 billion. In other words, don't be shocked if there's some management changes coming down the pipe. Bell ended the year with available liquidity of $4.5 billion, including $1.57 billion in cash, which reflects a decline of about $1.3 billion on a year-over-year basis, along with a net debt leverage ratio of 3.8 times and a solvency ratio of 118%. And just for funsies, we'll highlight here that the net debt grew by about $4 billion in 2024. Okay, time to check in on the segments. For those that watched our first edition of Bell earnings coverage back when they published their Q3 results, you'll know that the company operates out of 2 segments. The first is Bell Communications and Technology Services, or Bell CTS. The segment, which consists of the telecom arm of the company, i.e. voice, data, and satellite television, saw revenues decline 1.1% in the fourth quarter on a year-over-year basis, dropping to $5.68 billion. The decline was related to lower service revenue, which fell 1.6% to $4.55 billion, which is said to reflect ongoing declines in legacy voice, data, and satellite TV services, which combined with larger discounts for bundling. Product revenue partially offset this decline, improving by 0.9% in Q4 to $1.14 billion. For the full year, segment revenue declined 1.4% to $21.6 billion, with both service revenue declining 0.7% to $18.3 billion and product revenue declining 5.2% to $3.3 billion. The decline here was partially related to the closure of the Source store locations, leading to lower product revenue. This is also where Bell gets to blame the government of Canada's immigration policies for its decline, with the company seeing a 56.1% reduction in postpaid mobile phones net subscriber activations in Q4, while for the full year, activations declined by 49.9%. The customer base as a whole here grew by just 1,528 to 10.3 million in the fourth quarter. Mobile phone blended ARPU, meanwhile, declined 2.7% to $57.15 in the quarter. Elsewhere, growth has slowed in net new retail internet subscribers, with Bell seeing a 38% decline in growth on a year-over-year basis in Q4, while the full year saw a 30% decline in new subscribers, with Bell having 4.49 million internet subscribers as of year-end. Retail IPTV subscribers actually declined by 444 net subscribers in Q4, versus a gain of over 23,000 in Q4 2023. For the full year, IPTV subscribers increased by 3%, ending the year with 2.13 million subscribers. The other segment Bell operates under is Bell Media. Things fared slightly better here than Bell CTS in Q4, with revenues increasing 1.2% in the fourth quarter to $832 million. The slight improvement was attributed to a 0.4% increase in advertising revenue, a 2% increase in subscriber revenue, and total digital revenue growth of 6%. The quarter, meanwhile, saw adjusted EBITDA of $169 million, a 14.2% increase year over year. For the full year, revenue grew by 1.1% to $3.15 billion, which was attributed to an increase of 2.8% in advertising revenue, which was partially offset by a subscriber revenue decline of 1.1%. Adjusted EBITDA totaled $758 million in 2024, an 8.8% improvement year over year. And in terms of that subscriber base, Crave subscriptions are said to have improved 18% to 3.6 million, with the fourth quarter being the most watched quarter in Crave history for hours viewed. 2024 was also a record year in terms of watch time for the service, despite the decline in subscriber revenue. Finally, as if the 2024 results weren't a big enough kick in the nuts to shareholders, there's the outlook for 2025, which, well, isn't good. Revenue, after declining 1.1% in 2024, is expected to continue on this path. Current guidance calls for a revenue range of -3% to +1%, which is said to reflect competitive pricing flow-through pressure. Adjusted EBITDA growth is not expected to fare much better, with guidance currently calling for a decline of 2% to an improvement of 2% this year. Adjusted earnings per share is said to be anywhere from $2.65 to $2.80, equating to a decline of 8 to 13%. There is, however, a slight bright spot in the form of free cash flow guidance, which is calling for a range of $3.2 to $3.45 billion, which reflects an improvement of 11% to 19%, which also reflects a cut to CapEx of about $500 million in 2025. These numbers, however, do not reflect the acquisition of Ziply, which is expected to close in the second half of 2025. But don't worry, the company intends to maintain its dividend of $3.99 a share. Because why would a conglomerate in a decline ever cut its dividend to save the company? All right, so let's wrap it up. Bell, by all accounts, is a company that is in decline. Sales are down, earnings are down, EPS is down, cash flow is down. Yet the company is ran by a capital class that, rather than cut the dividend at the expense of shareholders, would rather plod along, allowing the ship to slowly sink, while destroying tens of thousands of jobs in the process. It's a company that has failed to adjust to a changing tech environment, despite operating in a highly protected sector that doesn't even have any real competition. Yet shareholders and the board continue to allow the deterioration of a once great Canadian institution. And when the massive and growing debt profile of this behemoth finally takes the company down as we currently know it, it'll be hard to feel sorry for anybody except the poor sucker that was just trying to achieve a middle-class life by working a 9 to 5 at what was once a respected conglomerate. Enjoy your dividend while it lasts, folks. All right, everybody. Thanks for watching. If you enjoyed this video, please give us a like. Let us know what you think in the comments section. Thanks for watching, everybody.